Let's get some insights in the news shaping the markets. For that, we welcome in Greg McBride, Chief Financial Analyst at Bankrate. Thank you so much for being here. So before I ask you just about the regional banks here, just the big picture on the Fed's 10th rate hike obviously puts us to the highest levels in 16 years. It was the fastest pace in decades of rising rates. What did you think? Did it matter? I mean, people were sort of expecting the 25 basis points. Now what?
Well, if the central bank is doing their job right, everybody expects what they're going to do. So, I mean, for monetary policy to be effective, they don't want to be catching people off guard with, whether or not they hike rates and by how much. So, yes, the quarter point was expected. And I think the other thing that was widely anticipated was a little bit of a shift in their language in the statement to communicate the idea that this could be the last hike for a while, that the Fed could now be on pause, sitting back, taking a little bit of a summer vacation from rate hikes to evaluate the cumulative effect. I mean, we're looking at 5 full percentage points worth of rate hikes, Nicole, since February or since March of last year. And that coupled with what's expected to be further tightening of credit and just an overall slowing of economic growth, I think they want to evaluate all of that and decide if more action is warranted, particularly with 2 more inflation reports between now and the June Fed meeting.
Right, understood. So as we see PacWest after hours yesterday, it was down about 50%. Same today. Western Alliance has been halted all morning. Here, thoughts, because a lot of people are just really trading the stock. They're not really looking at the balance sheet. I mean, you have sharks sort of swooping in. What are you thinking? Because these, as our Fed chair said, he said these banks are sound and resilient.
Well, a lot of this is somewhat reminiscent of the European debt crisis, right? Where as soon as one problem was solved, you had this game of whack-a-mole, where it was then, where's the next weakest link lie? And so, what did it take? It took this, big comment from Mario Draghi about doing whatever it takes to save the euro. That really stemmed the crisis. Well, we need something of that equivalent here. There was a very effective FDIC insurance program from 2010 through 2012 that insured all non-interest-bearing deposits. It basically protected the business accounts, all those uninsured accounts that have been, so subject to flight. It alleviates that problem. Now, whether that has to be approved at the regulatory or legislative level, that I don't know. But pulling that off the shelf, dusting it off, I think that would be an effective step to really kind of put an end to this, because otherwise it's just a continual game of whack-a-mole.
Right. And in the meantime, the Fed is, has been digging into the reserves, and there's been talk about that. These banks are preparing for loan losses, and, the $3 trillion level for those reserves. Is that okay?
Are you talking about the reserves that banks have parked at the Fed?
Yes.
And a lot of that is a byproduct of what we saw in the early stages of the pandemic in 2020, with all that liquidity that was created, and the fact that when markets were in free fall, anything that wasn't nailed down was getting sold for cash. Where did that cash end up? It ended up back at the banks and a lot of the larger banks. Now, we've seen 3 significant bank failures over the last couple of months, and those have been 3 of the 4 largest that we've ever seen in history. So, yes, there's been a lot of deposit money moving around, as one would expect in an environment where interest rates have gone up 500 basis points, the fastest pace of increase in 40 years.
Mm-hmm. Tell me about the consumer, because how much does the Fed want the consumer to be spending? They're still spending the same amount. They're just not getting as much bang for the buck, right? They're still out there spending, and the credit card rates, though, are starting to loom, right, at 20% plus. They're using those credit cards, and they're starting to realize, whoa, I better slow down, and they're digging into the savings, too. What's the consumer been doing? What are some of the habits? What are you watching? What are some of the trends?
Well, I mean, you nailed it. I mean, we've seen a situation where particularly lower and moderate income households, the budgets have been stretched, beyond the point of repair by inflation. And so what's happened? They've run down savings that had been accumulated in 2020 and 2021. They've started to pile up the credit card debt that had been paid down in 2020 and 2021, now being run back up. So credit card balances at a record high, more people carrying balances, and credit card rates at a record high. That is not a good mix. So everything that really illustrates the strain of households. And yes, the point about consumer spending, unemployment's near the lowest level in 50 years. It's at 3.5%. People have jobs. They're paying their bills. They're spending, but to your point, they're spending more because that's what it costs to get the same stuff they bought last year. When you adjust those spending figures for inflation, all of a sudden it's not so impressive. It's basically flat year over year.
Yeah. And tell me your thoughts about the job print for tomorrow. I mean, as you said, we've had a very tight labor market. We've seen the evidence of that. I know it's come off, but it's still very tight labor market. JOLTS, fewer job openings. Greg, tell me about tomorrow.
Yeah, we will see further cooling. I mean, I think, at this point, we're probably still looking at a respectable pace of job growth, more people coming into the labor force. But as time goes on, we're already seeing fewer job openings in the JOLTS. We will get to a point where the tide turns, and instead of job growth, we start to see job losses every month. Instead of unemployment staying low, we're going to see unemployment start to tick up. I just don't think we're there yet. We just haven't had that extent or that widespread cooling in the labor market as of yet.
I need your help with the interpretation just quickly. I mean, I'm almost out of time, but the JOLTS, right? So the JOLTS jobs report, the job openings, really, it's less than 2 for 1 for everybody looking for a job, but it's come down. But let me ask you your interpretation. As the number has come down, is it because they have fewer job openings because they're concerned about the economy, or is it because all the jobs are full and everything is so great?
No, it's, what you're seeing is companies starting to scale back. And all of a sudden they decide, you know what, maybe we don't have to replace that person that just left. We're a little bit uncertain about what lies ahead economically. Let's put a hiring freeze on those 10 open positions. We're not going to do that. And so, a lot of that comes before the layoffs that then come later and push up the unemployment rate.
Understood. Greg McBride, thank you so much. Bankrate. I had to clear that up because I've had some discussions with people on that. Thank you so much.